Hi, everyone. This is Crypto Market Mentor, and I'm Scott McGregor. Today, we're going to explore a popular topic in the crypto space, staking. Now, staking is a process where you lock up some of your crypto assets in a network to support its security and operations. And in return, you get rewarded with more crypto. While this sounds like a no-lose scenario, there are many factors to consider before you decide to stake your crypto, such as the risks, the rewards, and the options on where you lock up your coins. So let's dive in. We'll start with the pros of staking crypto. Firstly, passive income is one of the major benefits of staking crypto. You can earn passive income without really doing much work. It's kind of like earning a dividend on a stock. You just need to hold your crypto in a wallet or on a platform that supports staking, and you'll receive regular payouts based on the amount and duration of your stake. Depending on the network and the coin, you can sometimes earn from 5% to as high as 100% annual returns on your crypto. Network support is a big pro. The advantage of staking your crypto is that you are actively contributing to the security and functionality of the network. By staking your crypto, you are helping to validate transactions, create new blocks, and prevent attacks. You are also supporting the development and innovation of the network, which includes its adoption and growth. Staking is a way of showing your loyalty and confidence in the network and its vision. If you have a fundamental belief that the network token you're staking has a future, you are doing your part to help bring that to fruition. A third benefit of staking crypto is that it's more eco-friendly than other consensus mechanisms like proof of work. Proof of work requires a lot of computing power and energy to solve complex mathematical puzzles and compete for block rewards. Think Bitcoin miners, for example. The hardware and electricity can be costly, and the barrier to entry is quite high. Alternatively, you could just run a Bitcoin node to support the network, but you won't make any money doing that. It's mostly symbolic. And if you're planning on running a Bitcoin miner from your home, depending on your energy source, that extra power could lead to more carbon emissions and environmental impact. Staking on a proof-of-stake network, on the other hand, does not rely on such intensive calculations and competition, and it's much more energy efficient and less wasteful. Now, it's not all sunshine, roses, and unicorns. There are many cons and risks to staking crypto. Market risk is one of the main drawbacks of staking. Locking up your coins with a delay of getting them back fully exposes you to market risk. The price of your staked crypto can fluctuate significantly, depending on the supply and demand, the news, the events, and the sentiment. If the price goes down, you may lose some or all of your initial investment, even if you're earning staking rewards. Let's say you're staking 1,000 tokens of something and you may be getting 5% APY. If the value drops 50% on your token, you've still lost money and you're unable to exit the trade because your tokens are locked up, and that 5% doesn't even cover some of the losses. Even just to unstake your tokens, I've seen some delays as long as 30 days to get your assets back. There's also the opportunity cost of staking for active investors, which is the potential profit you could have made by trading or investing in other assets that may be going up while your token is going down. Another disadvantage of staking crypto is that you are exposed to platform risk. The platform or service that you use to stake your crypto may not be reliable, secure, or trustworthy. It may suffer from technical issues, hacks, scams, or regulatory actions that could compromise your funds or rewards. You also have to pay attention to the terms and conditions of the platform, such as fees, the lockup period and withdrawal process, and customer support if there even is any. Remember, you're dealing with decentralized software, not a bank, so there's no 1-800 number to call if things go wrong. A third drawback to staking crypto is that you're exposed to network risk. The network that you stake your crypto on may not be stable, scalable, or compatible. It may experience bugs, forks, attacks, or changes that could affect your staking experience. You may see unannounced fluctuations in the reward that you're supposed to be getting without notice. So you have to keep up with the upgrades and developments of the network, as well as the governance and voting decisions that could impact your stake and rewards. So you've decided to take that risk and stake your crypto. How do you do it? There are several options depending on your preferences and goals. Here are some of the most common ones. Staking pools are platforms or services that pool together the stake of multiple users and share the rewards proportionately. Staking pools are ideal for beginners or small investors who want to stake their crypto without running a node or dealing with technical complexities. Staking pools also offer more flexibility and liquidity, as you can join and leave the pool anytime. However, staking pools also charge fees, have lower rewards, and have less control over the network. There's delegated staking, and that's a process where you delegate your stake to a validator node that runs the network and earns rewards for you. Delegated staking is suitable for intermediate or large investors who want to stake their crypto with more security and efficiency. Delegated staking also allows you to participate in the network governance and voting. However, delegated staking requires trust, research, and due diligence, as you yourself have to choose a reputable and reliable validator node. Choosing the wrong one or one that goes offline could result in slashing, which is kind of like a fine that the validator has to pay for going down or slowing down the network. Your stake could be slashed unexpectedly, and you could lose some of your initial invested tokens. And finally, there's exchange staking, which is a service where you stake your crypto on a centralized or decentralized exchange that supports staking. Exchange staking is convenient and easy, and you can stake your crypto with just a few clicks and access other features of the exchange like trading, lending, or swapping. Exchange staking also offers more variety and options, as you can stake different coins and tokens on the same platform, so everything's in one place. However, exchange staking also involves risk, fees, and limitations, as you have to trust the exchange with your funds and follow its rules. Sometimes exchanges will offer incentives to stake with them. Coinbase One subscribers, for example, will get a higher rate than non-subscribers. So in conclusion, staking crypto is a rewarding and exciting way to earn passive income and support the network. However, it also comes with some challenges and risks that you have to be aware of and prepared for. In my experience, it's more beneficial to stake during a bull market when the probability for higher prices are in your favor. Staking in a bear market can lead to extreme wealth destruction. Trust me, because as you know, a lot of these assets can drop significantly, and it rarely makes it worthwhile to try and make 5% when your token has dropped 50% or more. As always, you need to focus 100% on managing your own risk. So that's staking, and I hope you found it helpful. May the odds be ever in your favor. My name is Scott McGregor. Follow me on Twitter @ScottTrades. Thanks for watching.